Friday, April 27th. Those of us wearing orange are very pleased with the Broncos in the draft. Sorry. Financial markets are behaving oddly. Not harmfully, but oddly. We got new economic data from the first quarter GDP, which at 2.3% annualized growth looks on the slim side, but if you take all the stuff apart, that's probably an understatement of the actual rate of growth. Certainly job growth is proceeding well. There is no acceleration that many expected from the tax bill and increased federal spending, but we're growing significantly above what the Fed sees as sustainable. So the Fed's going to keep coming. If we were on some sort of normal footing, normal in light of the last 50 years, all interest rates would be going up, and we'd be going up, in herky-jerky fashion, but up, and we're not. The 10-year Treasury note cracked 3% and then came back down a little bit. Mortgages made a run at 4 7/8, almost to 5, and they came back down. Very odd. Despite pretty good data and big-time market people thinking the Fed may hike 3 times more this year instead of twice, but they still have plans to hike next year, so it hardly matters whether they tack another one on at the end of this year or move it into next year. The 2-year T-note should be moving, and it's not. It moved in the last 2 weeks, but it stopped. It's just building in Fed hikes as they appear on the horizon, out 90 days, out 6 months. The normal pattern is for the Fed to continue to move upward gradually and then have a recession. It's the way it works. There are other things going on, and my strong hunch is that the condition of the outside world has more to do with American interest rates than ever. And the splendid visit by Emmanuel Macron is a good place to begin. Macron is playing a hand that has no cards in it. France is flat busted. Macron's soaring language about Europe and one Europe and more Europe is the solution to all problems. He's a brilliant character. French gives itself to double talk. But the French, as the rest of Europe, want to see Europe enter a mutualized state. That is, where they're all responsible for Europe's debt. They're all responsible for the condition of European banks. They have one budget, one tax system. Germany wants nothing to do with that. Germany's objective is to have all of the individual companies become Germans, behave like Germans, and run budget surpluses, run trade surpluses, keep their own economies on a German footing without any German assistance. So when Angela Merkel says one Europe, she means free movement of people. She means the hugely bureaucratic one system of laws out of Brussels, and that everyone is to be German. When Macron says one Europe, he means Germany, you're going to pay, known as a transfer union. Germans want nothing whatever to do with it. If you take apart Europe's numbers, nothing in Europe has changed in 10 years. The European Central Bank's overnight cost of money is still minus 0.4%. Despite, financial news say that there's this synchronized global recovery going on. Oh, horse feathers. There's a synchronized success of foreign central banks keeping their economies going, but there isn't any rectification of the underlying issues. France's national debt is now 100% of GDP. Its borrowing is growing faster than its GDP. Meanwhile, Germany has a budget surplus and is paying down its debt. France has a trade surplus. Germany has the largest trade, France has a trade deficit. Germany has the largest trade surplus in the world. There's going to come a moment when the ECB is going to have to pull back. And we're going to go right back to where Europe was 10 years ago, on the edge of falling apart. German bonds pay 0.59. Ours pay 2.96. Japan is in worse shape than Europe, sustained solely by the Bank of Japan. German 10-year bonds pay 0.05%. So we're sitting here asking ourselves, why haven't long-term interest rates gone up more in anticipation of what's coming from the Fed? And the answer is that our bonds are the best deal in the world. They're in tremendous demand because they have very high yields compared to the rest of the world. And there's a chance from the housing perspective that the Fed keeps on pushing up the short-term cost of money. The inversion of short-term costs above long-term takes place, but doesn't mean recession, doesn't mean much of anything. And we continue to motor along, and so long as we do not have the fact of inflation, it's a gorgeous spring day outside. Have a nice weekend.